Corvex, ticker MOVE, posted a massive double miss for Q2 2026 today.
A really brutal miss, yeah.
Revenue came in at $3.8 million, which widely missed the consensus estimate of $6.71 million. And earnings per share landed at negative 5.12, significantly underperforming the expected negative 3.17.
Right, and management actually declined to issue any formal forward revenue guidance.
Yeah, they opted instead to highlight a new run rate metric. They're pointing to approximately $22 million in contracted annualized recurring revenue.
Which is fascinating because despite missing on both the top and bottom lines, the market essentially forgave them.
Completely forgave them. The stock closed up 5.1% in regular trading at 11.72. Before pulling back maybe 3% in after hours.
So when you see a double miss trigger a stock rally like that, you know there's a serious underlying narrative overriding the historical execution.
Exactly. Investors are just entirely ignoring the trailing Q2 numbers. They're pricing in a completely different company going forward.
Which, I mean, we really have to look at the segment performance to understand. They basically underwent a fundamental rewiring of their corporate DNA.
Yes, like imagine a struggling local bakery, right? And one morning the owner walks out, throws away the ovens, and declares they're now an aerospace engineering firm building rockets.
And then on day one, they missed their new rocket sales targets.
Exactly. That is basically what happened with Corvex. Up until recently, they were known as Movano. They made the EV ring, a women's health wearable.
Right.
Then in March 2026, they merged with Corvex OpCo, entirely abandoned the consumer wearables market, and pivoted to building GPU-accelerated infrastructure for AI workloads.
It's an insane jump. Usually, publicly traded companies pivot incrementally, maybe a software vendor slowly expanding into cloud hosting. But jumping from consumer health hardware into ultra-capital-intensive AI data centers overnight.
You rarely see it. And to understand the margins and the commentary here, you have to look at how cleanly they cut ties with their past. On June 30th, they handed over their legacy healthcare assets, including that wellness ring business, just to settle a $1.5 million related party bridge loan.
The accounting on that move is actually pretty wild. By transferring those legacy assets to extinguish the debt, Corvex booked a $2.5 million non-cash gain on the disposal.
Oh, wow, really?
Yeah. They paid off a loan with assets they didn't even want anymore and recorded a gain on the balance sheet for doing it. It basically clears the decks. It allows them to enter the second half of the year with zero funded debt.
Which they desperately need because building out AI infrastructure burns through capital at a terrifying rate.
Absolutely.
So when you look at that $3.8 million in Q2 revenue, the context is everything. Yes, it missed the $6.71 million estimate, but it's a massive jump from the mere $100K they reported a year ago.
And more importantly, every single dollar of that current revenue is derived from the new AI platform.
Right. The legacy connected devices segment contributed zero.
But, generating that $3.8 million came at a really steep cost. They posted a $12.8 million net loss for the quarter.
Which makes sense. I mean, you can't become an AI cloud provider without bleeding cash during the build-out phase.
Exactly. Buying physical servers, securing data center floor space, signing power purchase agreements, all of that requires massive upfront capital outlays long before the first dollar of revenue actually hits the income statement.
That brings us back to why the stock went up. Management is essentially begging the market to ignore the recognized revenue and focus on that new ARR metric.
The contracted annualized recurring revenue on live compute.
Right, which sits at roughly $22 million as of mid-August. And they repeatedly stressed on the call that this comes from take-or-pay fixed-term contracts.
Which is huge. For an infrastructure investor, take-or-pay is the ultimate safety net. The customer is contractually obligated to pay for the compute capacity for the duration of the term, regardless of whether they actually run any AI workloads on it.
So it de-risks the baseline.
Completely. In the volatile world of AI model training, a developer's compute demand can spike and then drop to zero for weeks. Having a guaranteed baseline of cash flow is critical. As long as the customer doesn't go bankrupt, Corvex gets paid.
But, okay, if you're staring at this earnings report, the obvious question is, if they have $22 million in annualized revenue locked in, why did they only recognize $3.8 million this quarter?
Well, are they facing physical execution bottlenecks?
Yeah, exactly. Trying to coordinate the land, the power, the hardware.
That lag is just the harsh physical reality of AI infrastructure. There's an inherent delay between signing a multi-million-dollar contract and actually recognizing the revenue.
Right, because you don't get to recognize a cent until the GPU cluster is actually physically racked, bolted down, plugged in.
Actively cooled and officially handed over to the client in a live environment. It's a massive logistical headache.
So if a local utility is slow to upgrade a substation or, I don't know, liquid cooling parts are stuck on a cargo ship, revenue recognition gets pushed back.
Exactly. The 3.8 million is just what was physically humming during Q2. The 22 million is the annualized value of what they finally managed to get live by mid-August.
Got it. Which means the bottleneck isn't demand, it's deployment.
And the filings show they are actively tackling that deployment hurdle. I mean, they secured a multi-year agreement to provide NVIDIA Blackwell GPUs, which are the absolute cutting-edge chips right now.
Right, and they're connecting them with NVIDIA's Quantum 2 InfiniBand networking, which, for anyone tracking the hardware space, InfiniBand is basically the ultra-high-speed nervous system that lets thousands of these GPUs talk to each other simultaneously.
Without any data traffic jams.
Exactly. Because having the fastest chips in the world is useless if the data can't move between them fast enough to train a massive model.
The networking is arguably just as critical as the compute, and the physical requirements to run this Blackwell and InfiniBand combo are extreme.
Oh, the heat they generate.
Yeah, the newer generations run so incredibly hot that traditional AC just blows hot air around. You need direct-to-chip liquid cooling. And Corvex claims they can stand up a liquid-cooled environment in 2 weeks.
2 weeks? That's fast.
Extremely fast. It suggests they've either developed or acquired some highly efficient operational workflows.
And honestly, securing Blackwell GPUs in the first place is a major validator for them. NVIDIA tightly controls the allocation of those chips. They don't just sell them to anyone with a checkbook.
Right. If Corvex is receiving them, it implies NVIDIA actually views them as a viable partner, capable of serving high-tier developers, not just some flash-in-the-pan startup.
But selling raw GPU compute is ultimately a race to the bottom, right? It's a commodity business.
Totally. Margins will inevitably compress as more massive data centers come online globally from Microsoft, Google, Amazon. Corvex knows this.
Which is why they're trying to position themselves as more than just a passive landlord. The filings detail something called the Corvex Token Factory.
Yeah, currently in closed alpha.
Right. It looks like a software platform designed to give developers access to premium open-source AI models, utilizing a proprietary inference engine to maximize how efficiently the compute resources are used.
It's a classic attempt to move up the value chain. Instead of renting out the bare metal server and letting the customer figure out how to run their software, Corvex wants to provide the software layer too.
So at the Token Factory, they charge developers for the actual AI outputs, the tokens generated by the models.
Precisely. So instead of paying 10 grand a month to rent the hardware, the customer pays fractions of a cent for every word or image the AI generates.
It's a much higher margin, stickier business model. You're solving a software problem for the client, not just providing electricity and silicon.
But it also puts them in direct competition with the hyperscalers, the massive incumbent cloud providers like AWS or Azure, who already offer fully managed AI services.
Which explains their recent executive hires. They brought on Michael Craig as Vice President of Architecture and Site Operations.
He's a serious AI infrastructure veteran.
Yeah, you don't make that kind of hire someone whose whole career is scaling physical data centers unless you're preparing to pour concrete, secure, massive power leases and really play in the big leagues.
But ambition is expensive. We have to ground this theoretical pipeline in the harsh reality of their current balance sheet.
Yeah, let's talk about the notable risks here.
Because the risks threatening their execution are incredibly acute.
Let's dig into the cash position and the burn rate, because this is where the story gets tense. They ended Q2 with $21.7 million in cash.
Which was heavily padded by the merger.
Right, but they used $9.6 million in operating activities in just the first half of the year alone. So they have a runway, but they are burning through it fast.
The cash burn itself is expected when you pivot this hard, but the operating expenses require a much closer look. Total OPEX for Q2 was a staggering $19 million.
And if you're just skimming the earnings report, you might assume they spent $19 million buying servers.
But when you peel back the layers, $9.4 million of that, so nearly half was stock-based compensation.
Wow, So they're paying their people in equity to preserve their cash reserve,
Exactly. And management explicitly warned on the call that this high level of SBC is expected to continue for several years.
which introduces structural, ongoing dilution for retail investors. I mean,
Hmm.
SBC doesn't drain the corporate bank account, which is why early-stage tech companies love it, but it constantly increases the total number of shares outstanding.
Right. It's basically like slicing a pizza into more and more pieces. The pizza isn't getting any bigger, but everyone's individual slice is getting smaller.
To keep the value of your slice the same, the company has to magically grow the underlying value of the entire business at an incredible rate.
It puts them on a very steep treadmill. They have to run faster just to keep the stock price flat.
And the dilution risk goes far beyond just employee compensation. Look at their capital structure. They recently simplified things by converting preferred stock into common stock.
Following that approval in early July, they have about 56.6 million common shares on an as-converted basis.
But the real red flag for current shareholders is the S-1 filing. They registered 53.4 million shares for resale by existing holders.
This is a mechanical point that often burns retail investors who don't read the filings closely. When a company issues a primary offering, they create new shares, sell them to the public, and the company gets the cash to fund operations like buying more GPUs.
Right.
But an S1 for the resale of shares is completely different. It means early investors, legacy insiders, or parties from the merger are registering their privately held shares so they can dump them onto the public, open market.
So millions of shares could flood the market, increasing the supply of the stock and driving the price down.
And the company's treasury doesn't see a single cent of that money.
None of it goes to help fund the AI build-out.
It is a liquidity event for the insiders, not a capital raise for Corvex. And if the total as converted share count is around 56.6 million, an S1 registering 53.4 million shares means that almost the entire equity base of the company is now, or will soon be, eligible to be sold onto the public market.
That creates a massive overhang.
Yeah. Every time the stock price spikes on good news, those insiders might sell to lock in their profits, suppressing the stock price regardless of how well the underlying AI business performs.
And looking at the 10Q, the customer base concentration is another huge risk. My jaw kind of dropped. 93% of their revenue comes from just 2 customers.
The customers.
And it gets even more precarious. Customer A alone accounts for 64 to 65% of their total revenue.
It's like balancing a heavy table on a 3-legged stool, but 2 of those legs belong to the exact same client.
Exactly. If that one client finds a cheaper GPU provider or their AI model fails and they go bankrupt, the entire revenue stream of Corvex collapses overnight.
And that fragility isn't just on the demand side, it exists on the supply side too. The filings note that 26% of their purchases come from a single supplier.
I mean, they don't explicitly name the supplier, but reliance on highly specialized vendors is a known bottleneck in AI hardware.
You're relying on NVIDIA for the GPUs or someone like Supermicro for the complex server racks.
And if that supplier faces manufacturing delays, Corvex is stuck waiting. And let's be honest, if NVIDIA has a shortage of chips, are they going to prioritize a massive hyperscaler like Microsoft, or are they going to prioritize Corvex?
Exactly. If Corvex gets bumped down the priority list, their deployment schedule is derailed, which means they can't recognize that $22 million in ARR.
Adding to that risk profile, the SEC filings detail unremediated material weaknesses in their internal controls over financial reporting.
Yeah.
They actually brought in a top 10 accounting firm to help fix these issues.
Whenever investors see material weakness in a filing, alarm bells go off.
Yeah, does this mean the numbers we're looking at are just wrong?
Well, a material weakness means their internal accounting systems have flaws significant enough that a major misstatement could slip through undetected. But, in this specific context, it is somewhat explainable.
Because of the pivot.
Right. They just underwent a massive merger and completely changed their business model. The accounting software required to track the inventory and manufacturing costs for plastic wellness rings is very straightforward.
Yeah. The system's required to track complex capitalization rules, depreciation schedules, multi-year revenue recognition contracts for a liquid-cooled data center. That's a completely different beast.
Their back office is just struggling to keep up with the pivot.
Exactly. But while it's explainable, it remains a serious risk factor. Until those material weaknesses are fully remediated, there's a shadow of doubt over their reporting infrastructure.
So, to summarize the numbers today, Corvex has executed a wild, almost unprecedented transformation. They jettisoned a consumer wearable business to pivot directly into the most capital-intensive sector on Earth.
building liquid-cooled NVIDIA GPU clusters.
The Q2 earnings report was a stark reality check. A massive top-line miss, a steep 12.8 million net loss, and zero legacy revenue. Yet the market is clinging to their 22 million contracted pipeline, their take-or-pay agreements, and their ability to secure top-tier hardware. But under the hood, they're executing a high-wire act. They are in a race against time, balancing a heavy cash burn, massive potential stock dilution from early insiders cashing out, and a business model that currently relies on just two major customers to keep the lights on.
They've successfully acquired the hardware and secured the initial demand, which is impressive. But executing on the physical build-out, managing the capital structure, and diversifying that customer base before the cash runs out will ultimately determine if this pivot succeeds.
It really will.
Which leaves you with the final lingering question to ponder on your own. If a scrappy microcap company can successfully pivot overnight, abandon its core product entirely, and immediately secure top-tier NVIDIA chips and millions in AI infrastructure contracts, does this prove that the AI boom is creating boundless opportunities for agile underdogs to grab market share from the giants?
Or is it a blaring warning sign of an AI hardware bubble, where anyone with a data center lease and the letters A and I in their pitch deck is being handed a blank check?
Keep digging into the filings, keep questioning the underlying mechanics, and explore the fast-paced world of tech pivots for yourself. And be sure to follow the show for our daily earnings coverage and more deep dives into the stories behind the numbers.